Hi everyone. Friends, glad to see you again on the channel. We recently took a detailed look at the MACD indicator and noticed you really liked that video. So you genuinely have an interest in the market analysis. And today we will continue studying tools that help traders feel more confident and make decisions not based on guesswork, but on facts. The focus of our attention today will be EMA, the Exponential Moving Average. This is one of the most popular indicators used by both beginners and professionals. If you've encountered EMA before, you might have noticed that it's almost always displayed on traders' charts, but far from all beginners understand how to apply it correctly. And that's exactly what we'll break down today. What EMA is, how it differs from other moving averages, and what signals it provides. Let's start with how the idea of moving averages come about. They appeared as a technical analysis tool a long time ago, and there are many varieties of them, but they all have one goal: to help a trader see the main direction of price movement without getting distracted by minor fluctuations. Traders have always needed to understand the overall market direction without being distracted by every small price movement. But this market is too dynamic. It rises, falls, and stands still. To simplify analysis, they came up with a tool that smooths the chart and shows the trend. In 1992, Tushar Shande developed an adaptive moving average that took market volatility into the account. A bit later, in 1995, Harry Kaufman proposed his own version based on the idea follow the trend, but react quickly to changes. This became the foundation for creating the Exponential Moving Average, EMA. A simple moving average, or SMA, averages data equally and reacts to price changes with a lag. EMA, however, created specifically to put more emphasis on the latest data because this EMA reacts to fluctuations faster, meaning the trader gets more up-to-date picture, and this is a really important advantage. The market can be very dynamic, and a delay in even a few chart steps can influence decision making. I've said the phrase moving average so many times, but I haven't explained what it is yet. So, the essence of any moving average can be explained very simply. It's a line on the chart that shows the average price of an asset over a certain period of time. Every time the new price appears, the old one is excluded from the calculation, and the line seems to slide along the chart. EMA makes this process even more precise. In its formula, new data receives greater weight. That is, a fresh price has a stronger influence on from a week ago. As a result, the indicator reacts faster and shows more current picture of what's happening. Also, we can't not mention SMA. Simply put, it's a tool for the calmer analysis. It smooths the chart, removes the extra noise, and helps see longer term trends. If we compare the two tools, EMA works dynamically. If there are sharp movements in the market, it's the exponential average that adjusts to the situation faster. In practice, it looks like this. Many analysts use a 200-period SMA to understand the overall market direction. It's a kind of background, and long-term investors orient themselves by. But 20-period EMA is used for quick analysis of current intraday situations. A 50-period EMA, often chosen as a compromise, it helps balance between long-term stability and short-term changes. We've covered the basics now, but if you try to apply all of this in practice, you're likely to have new questions. How to choose the optimal EMA? Which indicators is it best to combine it with? On which time frame does it work more effectively? To give you the opportunity to delve deeper into these topics, I invite you to my Telegram channel. There, I share additional materials, useful tips, and visual examples. For beginners, there is a selection that will help you very quickly master the platform. interface and learn to work with a demo account. And for those already familiar with the market, there are breakdowns of strategies and recommendations for combining indicators. It's a place where knowledge turns into practice. You'll find the link to the channel in the video description down below. But now, let's get back into our topic. Now, to examine its functionality in more detail, let's answer the question, what hints does EMA actually give us? And here's the most interesting part. The EMA line is just a nice element on a chart, but a real helper for a trader. When the asset price is above the line, it can be seen as a signal that the market is set for growth. If the price falls below the line, it means the probability of a downward movement is increasing. The moment of crossover is also important. When the price rises and crosses the EMA from below upwards, it can be a sign that an uptrend is beginning. And if the price, on the contrary, falls and crosses the line from the above downwards, then there is a risk of decline. Another interesting feature of EMA is that traders often use several exponential averages with different periods at once. When a short period EMA crosses a long period one, this also becomes a hint for a possible entry or exit. And finally, EMA can act as a dynamic level of support, resistance. The price often bounces off this line as if it were a barrier. It's very important to understand that EMA is rarely used alone. It becomes truly useful when combined with another analysis tool. For example, support and resistance levels show where the price might stop, and the trading volume suggests how confident the movement is. In combination with the EMI, this data becomes much more valuable. Today we took a detailed look at EMA indicator. We learned its history, understood how it differs from SMA, and figured out exactly what hints it can give a trader. But remember, any technical analysis tool only works in a combination with practice. It's important not to just know what EMA means, but also to be able to apply it correctly. That's why I invite you once again to my Telegram channel. There you will find more information, additional examples, and will be able to discuss working ideas with other participants. It's a great opportunity to learn faster and move forward with confidence. Thanks for your attention. Subscribe to the channel so you don't miss new videos. The link is down below, and see you in the next video.